Assalamualaikum warahmatullahi wabarakatuh. Today I would like to explain about introduction to financial performance. For the definitions of financial performance, according to Malik and also Nadim 2014, financial performance is an analysis of the company's financial positions report in a certain period to find out how efficient and effective a company is in generating revenue. And the types of financial ratio, the explanation about ratio analysis means is a tool that was developed to perform quantitative analysis on numbers found financial statements. Ratio helps link different financial statements together and offer figures that are comparable between companies and across industries and sectors. And types of financial ratio, there is five. The first is liquidity ratio. Liquidity ratio is to measure a company's ability to pay off its short-term debt obligations. And the second is profitability ratio. This is show a company's ability to generate profit from its operations. And the third is solvency ratio. This is to quantify the firm's ability to repay long-term debt. And the fourth, efficiency ratio. This is to measure the effectiveness of the firm's of resources. And last is market ratio. This is to estimate the attractiveness of potential or existing investments. The first is liquidity. In the form of liquidity, there are the first is current ratio. Current ratio is to measure a firm's ability to pay off short-term liabilities with its current assets. The current ratio is an important measure of liquidity because short-term liabilities are due to within the next year. This means that a company has a limited amount of time in order to raise the funds to pay for these liabilities. For the formula to calculate the current ratio is current ratio equals current assets divided current liabilities. I would like to show you the example of the current ratio. This is the example. Alberto's Pizzeria is applying for loans to build a large terrace. Alberto's bank asks for the balance sheet so they can analyze the pizzeria's current debt levels. According to Alberto's balance sheet, the pizzeria report is $100,000 of current liabilities and only $25,000 of current assets. Alberto's current ratio would be calculated like this: to $25,000 divided $100,000 equals 0.25. The next slide is quick ratio. The quick ratio or acid test ratio measures the ability of a company to pay its current liabilities when they come due with only quick assets. And quick assets are current assets that can be converted to cash within 90 days or in the short term. Cash equivalent, short-term investment or marketable securities, and current account receivable are considered quick assets. The formula to calculate quick ratio is quick ratio equals quick asset divided in current liabilities. And also to show you the example of quick ratio, let's assume Jim's clothing store is applying for a loan to remodel the storefronts. The bank asks Jim for a detailed balance sheet, so it can compute the quick ratio. Jim's balance sheet included cash, uh, or of included cash is $10,000, account receivable of $5,000, stock investments of $1,000, and current liabilities $15,000. The bank can compute Jim's quick ratio like this. Uh, for the $10,000 plus $5,000 plus $1,000 divided $15,000 is equal 1.07. The next slide is profitability. The first, profit margins. The profit margin ratio, also called the return on sales ratio, compares the earning reported by a business to its sellers. It is the key indicator of the financial health of an organization. Creditors and investors use this ratio is to measure how well the company can convert sales into net income. Invest, Investor wants to make sure profits are high enough to distribute dividend, while creditors want to make sure the company has enough profits to pay back its loans. An extremely low profit margin formula would indicate and expenses are too high, and the management needs to budget and cut uh, expenses. The formula to calculate profit margin ratio is net income divided net sales. This is the example. Let's assume Jimmy's clothing store is applying for a loan to remodel the storefronts. The bank asks Jim's for a detailed balance sheet, so it can compute the quick ratio. Jim's balance sheet included cash of $10,000, accounts receivable $5,000, and stock investment $1,000, and current liabilities of $15,000. The banks can compute Jim's quick ratio like this: $10,000 plus $5,000 and $1,000 divided $15,000 equals 1.07. The next slide is return on assets, ROA. The return on asset ratio compares the net earnings of a business to its total assets. In other words, the return on assets ratio measures how well a company can manage its assets to produce profits during a period. Since company assets' sole purpose is to generate revenues and produce profits, this ratio helps both management and investors see how well the company can convert its investment in asset into profits. In short, this ratio measures how profitable companies' assets are. And the calculated for returns on asset ratio is equals net profit divided net total assets. For example, Charlie's Construction Company is a growing construction business that has a few contracts to build storefronts in downtown Chicago. Charlie's balance sheet shows total assets $200,000. During the current years, Charlie's company had a net income of $2 billion. Charlie's returns on an asset ratio looks like this: $200,000 divided $2 million equals 10%. The next is return on equity, ROE. The returns on equity ratio, ROE, measures the ability of a firm to generate profits from its shareholders' investment in the company. In other words, the return on equity ratio shows how much profit each dollar of common stockholders' equity generates. And this is an important measurement for potential investor because They want to see how eventually a company will use its money to generate net incomes. ROE is also an indicator of how well management is at using equity financings to fund operation and grow the company. The formula to calculate return on equity equals net incomes divided shareholders' equity. For example, Tom's Tool Company is a retail store that sells tools to construction companies across the country. Tom reported net income of ten $100,000. Tom also had $50,000 common shares outstanding during the year. Tom would calculate her return on common equity like this: $100,000 divided $50,000 is equal to. The next slide is return on investment, ROI. Return on investments calculates the profits of an investment as a percentage of the original cost. In other words, it measures how much money was made on the investment as a percentage of the purchase price. It shows investor how efficiently each dollar invested in a project is at producing profits. The formula for return on investments: investment revenue minus investment cost divided investment cost. For example, let's look at Richard Brokerage House for examples. Richard is a stockbroker who specializes in penny stocks. Richard made a somewhat risky investment in a liquid metal stocks last year when he purchased 8,000 shares at $1 per share. Today, a year later, the fair market value per share is $3.50. Richard sells the share and uses an ROI calculator to measure his performance. 2000 to 28,000 minus 8,000 divided 8,000 equals 2.5. The next is leverage. The first, debt ratio. The debt ratio measures the proportions of assets paid for with debt. One can use the ratio to reach conclusions about the solvency of the business. A high ratio implies that the bulk of company financing is coming from debt. This is a risky financial structure since the borrower is at risk of not being able to pay for the associated interest expenses or paying back the principals. Low debt ratio reflects a conservative financing strategy of using only equity to pay off assets. For the formula, debt ratio equals total liabilities divided total assets. For example, Jim's guitar shop is thinking about building an addition onto the back of its existing building for more storage. Jim's consult uh, with his banker about applying for a new loan. The bank asks for Jimmy's balance to examine his overall debt levels. The banker discovers that Jim has total asset of uh, 100 $100,000 and total liabilities of $25,000. Jim's debt ratio would be calculated like this: $25,000 divided $100,000 equals 0.25. The next slide is market. The first, earning per share, EPS. The earning per share ratio measure the amount of a company's net income that is theoretically available for payment to the holders of its common stock. A company with a high earning per share ratio is capable of generating a significant dividends for investors, or it may plow the funds back into its business for more growth. In either case, a high ratio indicates a potentially worthwhile investment depending on the market price of the stock. For the formula earning per share, net income minus preferred dividends divided number of common shares outstanding. For example, ABC company has a net income of $1 million and also must pay out $200,000 in preferred dividends. It has both above a bag and sold its own stock during the measurement period. The weighted average number of common shares outstanding during the period was 400,000 shares. ABC's company's earnings per share ratio is 1 million minus $200,000 divided $400,000 equals $2 per share. And the next is price to earning ratio. The price to earning ratio calculates the market value of a stock relative to its earning by comparing the market price per share by earning per share. In other words, the price earning ratio shows what the market is willing to pay for stock based on its current earnings. The formula to calculate price to earning ratio, current market ratio per share divided earning per share. For example, the Iceland Corporation's stocks is currently trading at 50,000 per share and its earning per share for the year is $5. Iceland's ratio would be calculated like this: $50 divided $5 equals 10. The last is dividend yield. The dividend yield ratio shows the number of the dividends that a company pays to its investor in comparison to the market price of its stocks. Thus, the dividend yield ratio is the return on investment of an investor if the investor were to have bought the stock at the market price on the measurement date. For the formula, dividend yield ratio equals cash dividend per share divided market value per share. For example, Stacy's Bakery is an upscale bakery that sells cupcakes and baked goods in Beverly Hills. Stacy's is listed on smaller stock exchange and the current market price per share is $15. As of last year, Stacy paid $15,000 in dividend with 1,000 shares outstanding. Stacy's yield is computed like this: $15,000 no $15 divided $15 equal 1. Well, for the conclusions, making a simple financial assessment of another organization is straightforward and the necessary information is readily available. This means that you can compare the performance of the organization with its previous track record and with a performance of other similar organizations. You can also make comparisons to see how profitable the business is, how efficiently it is performing, and whether it is able to pay its bills on time. Well, that's all my presentation. Thank you very much for your nice attention. The last I say wassalamualaikum warahmatullahi wabarakatuh.